I'm John Leroux, and I'm here with Tim Fox from NEI Investments. Well, tell me a little bit about what you do at NEI.
Sure. So essentially, I manage a team of investment professionals who are working with advisors just like you every single day, and they're sharing our investment philosophy here at NEI and our process as it relates to investing responsibly.
Well, let's talk a little bit about that ESG, environmental, social, and governance, or as we commonly refer to it as socially responsible investments. What does that really mean?
Yeah, it's a great question. As you mentioned, the industry defines RI using those three factors, right? And some of your listeners may be familiar with that E, the S, and the G, as you've mentioned. What does it really mean? It's simply boiled down to the air that we breathe. It's the water that we drink. It's how companies treat their employees and how those companies take responsibility for the way in which they operate. Why is it important to your second question? It's because when you look at the world from an ESG perspective, two things happen. One, you can identify risks. And second, you can recognize potential opportunities. And I think both those things can have a significant impact on share price.
And now that you say share price, how does that apply to your overall stock selection process when overlaying ESG?
Yeah, it's a great question. So when we analyze a company to see if we want to include it in a portfolio, we assess numerous financial factors like profitability, cash flow projections, valuations. In other words, what is the company priced fairly? What are the growth expectations? What's the management team like? It goes on and on and on. What we do is we take it one step further and we add the data that we collect using our responsible investing lens. And that really helps us do those two things, right? Identify risks, so stay out of trouble. And second, recognize potential opportunities that we see through the ESG lens.
So tell me, that difference in the way that you look at things, how is it as compared to people in non-ESG stock selection funds?
Sure. Well, this isn't really anything new in terms of the way that we look at the fundamentals. Traditional investing is always taken into account lots and lots of inputs. It's just right now, there are more and more data points being made available to investors than ever before. So we take that data, which is more the qualitative. How do companies interact? What risks can we mitigate? What opportunities can we see? Perfect example that I'll give you that really uses the ESG lens is, some things that we're seeing in the news right now. Imagine you turn on the 6 o'clock news and you see the wildfires that we're having in Jasper, Alberta. As a result of that, we look at investing in companies that maybe create wildfire mitigation equipment or fire protection coatings. We wouldn't have seen that without an ESG lens because we look at the impact that we're having on our natural habitat. Another example is, what if a company has poor governance, or the G? If they have poor governance and there's a privacy breach, millions and millions of customers' personal data is compromised, and as a result, the stock tumbles. So those are examples that using an ESG lens really gives us an opportunity to look at the world a little different in addition to the fundamentals that most asset managers look at.
Are there any other key differences that non-ESG managers and you guys have that are worth highlighting?
Sure. Like traditional investing, we've got a toolkit, and that toolkit is what we use to help influence change at the companies that we hold. So what's different with us is not only do we invest in those companies, but we can have an impact on the way that they operate. So this includes voting at the company's annual general meetings. This means engaging dialogue like you and I are doing now. All those activities, things we called stewardship activities, give us an opportunity to really have an input and impact on the companies that we're investing in beyond just a sort of a bottom line share price perspective.
Oh, cool. So you've touched on some of those ESG factors. Is there maybe some examples that you can share on how this differentiates and is relevant to investors?
Yeah, like I mentioned before, there's things that are happening in our world every single day that gives us an opportunity to look at things differently. I reflect back on, and you are surely old enough to remember the Exxon Valdez oil spill. and the implications that it had. What's really absolutely astonishing is back then in 1989, when that disaster occurred, do you know the share price only fell 4%?
Yep.
Only 4%. And in fact, 4 weeks after that event, the share price had completely recovered. Well, fast forward, a couple decades later, and we have another Exxon Valdez in a different part of the world. This time, this is BP or petroleum, BP, British Petroleum. Their share price went down over 40% as a result of a similar oil spill. So the point is, the world now is watching. And what was not on their radar back, in the 80s and early 90s, now very much the world is keeping a very close eye on the way the companies operate. And as a result, we can look at those companies differently and minimize risk and look for opportunities.
Yes, and those opportunities in the RI space do offer a different perspective for investors. Talk to me a little bit about that.
Sure. Opportunities, these are opportunities that exist, everywhere we look. And what we've got to do is make sure that we're minimizing the risks associated with them. And what we're looking at is risks that include certain things. Reputational risks. So we talked about British Petroleum and we talked on Exxon Valdez. Those reputational risks are massive because at the end of the day, it has an impact on the bottom line share price. So we look at reputational risks. We look at regulatory risks. Is the government or is the environmental regulations requiring companies to limit their greenhouse gas emissions? They could have potential cost to a company if they're not abiding by those regulations. And they could get fined, again, affecting share price. And business risks, as I said to you before, what if they are not playing nice from a business risk perspective and they're putting their business at risk? And at the end of the day, that's going to have an impact on share price as well. So all those things need to be taken into account when we assess the risks associated with a company.
Well, in assessment comes the thought carbon footprint. Mm-hmm. And is there a way that we can take a look at how the funds work and if there's a possibility of measuring a fund's carbon footprint on the world?
Yeah, everybody wants to know the carbon footprint. And obviously in Canada, that's a touchy subject because there's a tax associated with that. So if we take it one step back, really carbon footprint, certainly from a company perspective, is the total amount of greenhouse gas emissions that it generates from its business. Simple, right? The challenge is it's really hard to measure because that could come from all the different energy sources. So if it was real easy, if the company just plugged into their electrical socket and ran their business out of that one socket, that's easy peasy. We know exactly how much energy they're generating. But what happens when you think of a large company like Loblaws and all the sort of the downline businesses and all the things that are involved in getting those products on those shelves? That's hundreds and hundreds of companies across the supply chain that are part of that business. And it's a real big challenge to understand all the emissions that are created within that supply chain. Really difficult to measure. So, it sounds simple enough, but when you look at complex companies, and there are many, it becomes bigger and a bigger challenge to try and figure out what that footprint actually looks like.
Well, it's funny. This leads into a very different question. The word is greenwashing. What does the term really mean?
Sure, greenwashing. So really refers to false or misleading information with respect to a company's sustainability credentials. So in other words, if a company makes a claim about the way that they invest and they make it sound more environmentally friendly or more socially responsible than it actually is, that's in fact greenwashing. And it can also apply to companies when they say that they hold themselves out to be more environmentally friendly than they actually are. Or maybe they focus on one positive area and they omit others. Here's a perfect example that you might recall. A while back, Volkswagen, they were in the news because they were accused of cheating on pollution tests, and they were accused of modifying engine software, which made the cars look better on paper from an emission perspective. Well, obviously the proof is in the pudding. They were taken to task, and this has cost VW somewhere in the range of 31 billion euros to date. So that's a perfect example of greenwashing, where companies make claims that may not necessarily actually be accurate.
I believe Toyota has been in the news for something similar recently.
There's no shortage, especially as it relates to the automotive sector, because emissions are a very tricky thing to be able to measure and manage. So I wouldn't be surprised to see others along the way.